mainstream economists, which I'm thoroughly enjoying. And I'll go through some of them. The first was Narayana Kocherlakota, whom you may know as until recently the Federal Reserve President. It's a quite remarkable development just in the last couple of months, really, that a whole bunch of mainstream economists have finally started admitting they haven't got a clue how the economy functions. So the first was Narayana Kocherlakota, who seems like quite an accessible character compared to most of the neoclassicals. He was a very staunch, what they used to call freshwater neoclassical believer in the real business cycle approach to modelling. And over a few years' time, he's flipped around quite completely, and now I come with this statement just back in July, saying we simply do not have a settled, successful model of the economy, or theory of the economy, which is a huge change from what he was like some years ago. Blanchard, who actually wrote me a tweet being very annoyed about me sending him up in a fairly satirical YouTube post you can see on my last YouTube recording, he actually has come out to say that DSG models, which he was a champion of building, if you know from Michael Kumoff, he was very singular and linear in his thinking about them. He's now finally come out saying that there's many reasons to dislike these models. And finally, they're realising that lousy assumptions aren't a good basis for a theory. They're saying they're not just simplifying assumptions, they're at odds with what you know about the real world. But my favourite is one I highly recommend reading by Paul Romer, who developed what's called, what's his name, endogenous growth theory for the neoclassical some years ago, and is highly respected. He wrote this amazing paper just a couple of weeks ago, The Trouble with Macroeconomics. The speech he gave back in January, but he's been writing up and just got out. It was released by accident just a couple of weeks ago. And he starts by saying macro's gone backwards for the last few years, and they dismiss the facts with obtuse ignorance. Their fluctuations come from imaginary variables that might as well be caused by gremlins and trolls, and he actually uses those words in his paper. And he finally says that they have such a non-committal connection with the truth, you might as well stop calling them, and you can't even call them postmodern, he's just calling them post-real, which is one hell of a put down. He's writing the sort of stuff I used to write, but he's a mainstreamer that would have been expected to get the Nobel Prize in economics at some stage, and he's coming out trashing the theory. So the question is, what do you do in that case? Well, the advice I'm going to use here, which is fairly obvious to people in this room, if the mainstream economist says something, the opposite is probably true. So to give you my 5 little starting points for here, they of course claim capitalism is stable. And this is my favourite neoclassical nutcase, the Edward Prescott, who invented real business cycle theory, saying back in 1999 that capitalism is stable and converges to a constant growth path with standard being doubling every 40 years. So that obviously means that capitalism is unstable, and of course on that Kaminsky's your classic on that point, saying it's inherently unstable due to the characteristics the financial system has to have to be consistent with full-blown capitalism. Number 2 is that banks don't matter. Well, I don't need to tell people in this room that's nonsense. This is my old mate Paul Krugman, who's having a go at me some years ago. So the logical deduction there is that banks are crucial to macroeconomics. And of course, Hyman Minsky argued the whole idea that everybody in this room knows very well about banks creating money, that repayment destroys money. I must say it took me some time to get my head around that. And that's therefore part of the growth and rise and fall of demand. And you might know that the Bank of England's recently come out and said the same, and this was actually before Michael Kumoff turned up on staff. Michael, by the way, is happily ensconced in London, and a good mate. I'm very glad that he's nearby. We see each other quite frequently. But their quarterly bulletin came out saying the basic case everybody in this room knows about banks creating money when they create a loan. And for other conferences, I'd go through this little model here. This is a model done on my Minsky software, where I've set up their mythical model of loanable funds, and show them when I vary these 2 parameters here, which change the rate of lending and the rate of repayments, it has overall impact upon the rate of growth, and GDP doesn't have much change at all. Massive changes to the debt ratio, no real change to GDP. So if they were right about banks just being intermediaries, they would be right to ignore money as well. But of course, when you change it around, then it takes me about 30 seconds to go from that model to this model. In this case, changing the level of growth, change the level of debt, changes the rate of growth dramatically. So you've got to take account of it. And it's taken me some time to make a good case about whole logic behind it. I'll do that at the end of the presentation. Number 3, of course, Bernanke said the great moderation was a great thing, a welcome change to the economy. Well, that means it must have been a warning of a crisis, and I can quote myself on that front. Back in 1995, talking about my Minsky model back then, saying that a period of relative tranquility is only going to be a lull before the storm. And number 4, the financial crisis is over. This is Larry Summers, and Larry is saying that why is growth anemic in the absence of major financial concerns? Well, that points out that the financial crisis must still be with us. And this is quoting from my new book, which will be coming out in April, May of next year, that there are what I call debt zombies to be, and I'll identify some of those in a moment. And the walking dead of debt have already been zombified by the crisis back in 2008, and of course the Japanese before that. And so long as private debt is as high as it is, we're still in the crisis. The next one, which is a new argument I'm taking on these days, is how do we approach macroeconomics now? Because one important thing with the mainstream is they believe you have to have a sound foundation for starting building a model, and that's not an invalid belief. The invalid belief is thinking they've got to work from the bottom up. Well, that implies, of course, the right way to go is top down. So I can show if you start from simple definition of the employment rate, the wages share of output, and the debt to GDP ratio, you get 3 absolutely true statements because they're simply derived by taking definitions and putting them in a dynamic form. And the first is the employment rate will rise if economic growth exceeds population growth and labor productivity. Look, I might jump to the main points because a lot of this stuff is stuff that I'll be getting through other presentations overall, but just I'll page through mine rather than going by slide. It might be less intensive on the screen there. But what I show in doing my modelling is that when you put together that set of definitions and put it into a dynamic model, you get 2 possible states. One is the thing that neoclassicals think is actually happening, which is convergence to equilibrium. And you can see that happening there with the employment rate heading towards an equilibrium and the debt ratio heading towards an equilibrium. But what's actually going on is this: apparent convergence and then divergence, followed by a breakdown. And that's what my model actually generates a great moderation, followed by a crisis afterwards. And when I put it into a more complicated form, I get a breakdown that looks like this. This is a more complete model where everything seems to settle down and then the economy collapses. And that's really, I think, what the neoclassicals got caught by when the crisis hit. But what I want to indicate here, I'll actually put this one up on simulation terms. Why are we not out of the crisis? And the simple reason is we haven't got rid of the level of debt yet. So this chart, I hope it comes up okay on screen, shows the ratio of private debt to GDP from the start of 3 crises. The red line is the Great Depression. The black line is Japan's crisis from 1990. And the blue line is where we are right now in America. And you can see that private debt began at about 150% of GDP, but I've normalised them all to 100%. Rose with the deflation of the Great Depression, but then by the time the Roosevelt recession hit, was down below the level we have now in terms of years after the Great Recession, and then plunged with the Second World War down to less than 40% of the crisis level in terms of the debt to GDP ratio. We're still at 92% and rising again, and we're headed more for Japan's situation where they've been stuck at 80% of their private debt crisis level for going on 10 years. So that's why the crisis is still continuing. Now, I go through some logical arguments here, and again, given the bad graphics, I won't try to animate the argument. But the basic proposition is that I've now proven, and I've now satisfied my various colleagues in my post-Keynesian area who thought I was getting something wrong, that aggregate demand is the sum of the turnover of existing money plus credit. And that's finally been accepted by my post-Keynesian crowd. So I do the analysis here on about 3 slides. What I'll do is I'll send this argument your way, Stephen and Jamie, and you can pass it around. But it's basically a logical mathematical proof that aggregate demand is the sum of the turnover of existing money plus credit. Okay, so I've finally proven that. Now, what I want to do is explain fairly simply in a logical step why it happens. And I'll push my luck with the animation here because it's worth having this come down point by point because there's a fair few logical points coming down at once. Imagine you have an economy which has the turnover of existing money is $1,000 billion a year, so $1 trillion a year. Imagine that's your initial starting point. And it's growing at 10% per annum. So there'd be 1.1 trillion this year, 1.1 trillion the next, 1.2 to that. And private debt is 50% of that turnover of existing money, or 500. So Kosher Lakota, who was the head of the Minneapolis Fed, has now come out saying that they don't have a theory of the macroeconomy, which is a pretty big change in their more arrogance about them knowing how the world operates, even if they didn't see the financial crisis coming. Number two is Blanchard, who's coming out saying that their models are based on assumptions that are wildly at variance with what they know about consumers and firms, which is a huge shift. And Paul Romer has a great little paper called The Trouble with Macroeconomics, where he literally talks about their models being driven by gremlins, trolls, ether and phlogiston. It's quite a remarkable put down to the mainstream, so I highly recommend taking a look at that. So that's a great development, and it's good timing coming when it is. In the meantime, I've also managed to prove the argument that I've been making for some substantial time about the relationship of credit to aggregate demand and to asset markets. So I now have proven, to the satisfaction of my post-Keynesian critics on this front, and they matter far more than their classicals, of course, that aggregate demand is the sum of the turnover of existing money plus credit. And then when you include that in your thinking, you get the reality that a slowdown in the growth of private debt is enough to cause a crisis, because that can reduce aggregate demand simply by a slowdown in its rate of growth. It doesn't have to go negative. So I explained that in the presentation, but of course that wasn't working properly. And the third thing, I've also derived a way of explaining macroeconomics by working from strict definitions. Neoclassicals try to build the world from the bottom up. That's their modelling approach. Take an individual, extrapolate it to the market level. I say we should go the other way around. Start from definitions, like the debt ratio, for example, and work down. And I've managed to do that successfully as well. And I might finish with what I'm coming out with in the publication early next year. I've written a new book for Quality Press with a 25,000 word limit to the series it was published in, which is a great little discipline. And it's called Can We Avoid Another Financial Crisis? And of course, I said it could have been a one-word book. It's actually 25,000 roughly. And the basic answer is that we can't, because the momentum of too much credit and too high level of private debt has been set in the many, not the United States and the UK, of course, which have already had their crisis, but China, Australia, Canada, South Korea, Sweden, Norway, Belgium possibly, Malaysia, Singapore, Thailand. So about 16 or 17 countries I identify, and I go through the logic behind that in the book. And what I might do, let's just bring up the one little graphic here, which is a fairly useful little graphic. I'll see if I can share my screen on this front. I won't push my luck, but I'll give it a quick try. Bear with me. I'm not sure we're going to be able to see that clearly. Can you see it?
Not yet. No, it's coming. It's coming.
Yeah. I'll give it a couple of seconds and hopefully it gets up there, and then I'll stop sharing to save bandwidth.
There it is. There it is. We got it.
There you go.
Yeah.
Okay. Yeah. I hear the bandwidth problem right there. What I've done there is graph level of private debt on the horizontal axis and the rate of growth of debt, which is credit, on the vertical. And you can then plot the transition of the whole global economy from low levels of debt and low credit back in the 50s and 60s up into the danger zone where debt's greater than 1.5 times GDP and credit's greater than 10% of GDP. And on that pattern, that identified the US and the UK for the crisis 8 years ago, but now the main countries that are in the danger zone are China, Hong Kong.
Couldn't see that
Yep.
graphic.
No, he knows. He put it down. Don't worry. He gave it to us in 5 seconds, and that was all.
Can you hear it okay, or?
Yeah, we could hear, but we couldn't see the graphic if you want to put it up there.
Oh, okay, I'll put up the current one for, I'll put the current one up for the current situation, the most recent data. Let's see how that works. So can you see that?
No, we see.
It's coming. It's coming.
Okay.
Yeah.
I'll get rid of the danger zone graphic just to make it easier. But you can see your countries that are the most prominent with credit greater than 25% of GDP per annum and debt levels above 200%. China, Hong Kong, and dear Ireland is in there again. But I've got a feeling that's because Ireland is fiddling the books to try to reduce tax for its multinational clients like Apple. But the other countries that are in there, just down here are Korea, Australia, Canada, Belgium, Sweden, Norway. And then on the periphery of the border, coming the wrong direction, in terms of implying they're going to have trouble, is Singapore, Malaysia, and Thailand. So those are the countries that I identify as having a crisis coming up in the near future. Of course, the ones that have already got a slump, US and UK down here, but Greece, Spain, and Portugal, the pigs, so-called, the countries that have been destroyed by the euro, they're all in negative credit. So they're down to the stage where I think we better give it an S. I think we better give it an S.
Yeah.
Not
we'll
works well. It's just
we'll collect some questions and email them to you and distribute your answers later after the conference.
Yeah.
Okay.